Hey, good morning, everyone. Marty Missouri here, June 21st, 2025, with your end of week update. Folks, we're going to cover quite a bit of ground this morning, although I'll try not to keep you all day, I promise. I want to start with my notes here from this morning. And I say here, while our core allocation is what we would call very all-weather currently, our tilt presently lends itself, and will more so over the coming years, I suspect, to the messaging in Peter Bookvar's note this morning. And what I mean by that is we have a weaker dollar thesis going forward on a longer term basis, recognizing that particularly from these levels, the dollar could pop, and particularly from the world we live in now. I'd say specifically the geopolitical concerns, maybe to some extent interest rate concerns, but it wouldn't surprise me to see the dollar get stronger for a bit here off of what I think are pretty oversold levels right now. However, again, our longer term view is that the dollar will indeed trend notably weaker over coming years. And I just want to more or less paraphrase here. Canadians sold $57 billion worth of treasuries in April, and that was 13.5% of their stockpile. Apparently, going back to 2000, there is not another month that saw more selling. In context, though, they have been steady buyers for years, so maybe this is just a one-off, but something to watch, I agree. For the month of April overall, there was a net reduction in foreign holdings of U.S. Treasuries of $40 billion, with all the selling coming from private holders, as central banks did buy a modest amount. Sellers came too from Hong Kong, Singapore, China, India, Korea, Norway, Germany, France, and hedge funds in the Caymans. The UK was the biggest buyer, but that could be anyone using UK banks. Japan, the largest foreign owner, did buy $3.7 billion worth. As the Treasury is issuing ever more paper, we need all the help we can get. The loosening of the supplementary loss ratio for banks doesn't mean that there'll be any major bank buying of long-term treasuries like I think some people think. If they add to their holdings at all, it will most likely be T-bills, especially after the experience of Silicon Valley Bank taking on too much duration risk. Just a note with that, I do want to just kind of speak to that because that comes up every now and again. And it has to do with the perceived, stupidity, I guess, of the Treasury issuing so much short-term debt around COVID, debt that would only have to be refinanced later at a higher interest rate, and therefore putting a bigger burden on the budget deficit. The idea being interest rates got so incredibly low, why didn't you lock up that debt for a long period of time? The problem with that being, and this is a big problem, would be the experience of the portfolios of the buyers of that debt. So let's just say they issued a bunch of 10, 20, and 30-year bonds amid the COVID collapse where interest rates went down to nothing, right? And those bonds got bought by the usual suspects. The portfolios of those usual suspects in the aftermath, as inflation kicked in and interest rates went up, would be utterly devastated. And that happened to Silicon Valley Bank. They had their reserves invested in longer term treasuries. Fear gripped their depositors and they wanted their money. At a time when interest rates had gone up, the value of those treasuries had fallen precipitously, and they did not have the market value necessary. They did not have the liquidity to take care of the withdrawals. And the bank is no longer, as are another couple of banks that suffered the same thing. So make no mistake, if the Treasury had issued a bunch of long-term debt, the ultimate impact on portfolios out there would have been, I suspect, devastating in the higher interest rate environment. And that's what Bookvar is saying here. Having seen that experience and still risk of higher inflation, and we do think inflation is going to be structurally higher over the long run, that could be problematic at times when interest rates spike. And here's that downtick of Canadian holdings in treasuries. Speaking of foreign ownership of U.S. equities, And this speaks to a theme that we've been talking about for some time. Torsten Slok had a great chart on this on Wednesday, and you can see that it's a record high. I continue to argue that this is now a global reassessment of the extent they still want to own much in U.S. stocks. Now, the point we've been making is that there's been this extreme valuation mismatch between U.S. stocks and foreign stocks. And last week I talked about Europe in particular. And the, I think, obvious rotation is not over out of U.S. assets into cheaper assets in other places. And a falling dollar over the next few years is really going to support that notably as well. Hence, as I keep mentioning, our notable outperformance of the U.S. stock market so far this year. Now, there's a second half of this year to come, and it wouldn't surprise me, and we've been talking about this internally, that some of the things that have done so well for us in the first half, because they've done so well, despite the fact that they're still relatively cheap, when the market struggles, and it would not surprise me at all, as I mentioned in the last video, if we do see some corrective action early summer, say we get into July, and it could be that some of the things that have done so well the first half may underperform U.S. equities early in the second half. We'll see. I think the better, macro thinkers and analysts, they are looking for opportunities to add more to those other areas if indeed we get some weakness in the market. So who knows? Maybe they'll hold up just fine in the second half as well. And then he speaks to what I'm talking about, the advantage in non-U.S. securities when the dollar is weaker. A European owner of the S&P 500 is actually down 9% year to date, where the S&P is up like 1.4% year to date here in dollar terms. But they're up 17% in the German index. And in dollars, they're up 30%. Remember, a week ago, I said that our European exposure is up 25% on the year. And let's say a good half of that is because of the weaker dollar. The Spanish index is higher by 20% euros, 33% in dollars. Italian index is up 15% euros, 28% in dollars. A yen buyer of Japanese stocks is down 3.7%, but the same buyer is lower by 6% in the S&P 500, goes on and on. So you get the point. Weaker dollar is bullish for non-U.S. securities. And here's that chart that he referenced with record high ownership of U.S. equities by foreigners. It's something like 70 cents of every dollar that's flown into U.S. equities comes from a foreign investor. And that speaks to one of the benefits of a trade deficit in terms of the resulting capital that flows back to buy U.S. assets. Gold, which we're bullish longer term, and by the way, not even for this reason, although this just sweetens our bullish case, and that is that central banks continue to buy. The World Gold Council did a survey. Here were some highlights. Overwhelmingly, 95% believe that global central bank gold reserves will increase over the next 12 months. This year, a record 43% believe that their own gold reserves will also increase over the same period. Interestingly, none of our respondents anticipate a decline in their gold reserves. The majority of respondents, 73%, see moderate or significantly lower dollar holdings within global reserves over the next 5 years, and that speaks to our thesis of a lower dollar. And then these charts that basically show you that they're increasing their gold reserves and anticipating a lowering of their dollar-denominated reserves 5 years from now. And again, a globally diversified portfolio, one that also includes commodities, one that includes precious metals, will probably, at least I should say probabilities point to that being potentially a notable outperformer of a U.S.-centric portfolio in the coming years. Just finished scoring the PWA index, and as you can see, it's taken a leg lower. In fact, this is the lowest it's been since we peaked into the positive here briefly a few months ago. And I wanted to share just some of the inputs with you. One that really jumps out at me is home builder sentiment. So these lines represent the overall scoring. And by the way, below 50 means contraction. That's net negativity, if you will. So the overall score being 35, and the current conditions and expectations are both below 50 as well. So home builders are not feeling very good, and this is a nationwide poll about their prospects currently and over the next 6 months. Prospective buyers traffic is way low at the moment as well, and inventories are beginning to rise and so forth. So state of the housing market is suspect a bit. We did see a drop in housing starts, although most of that was in multifamily. And we did see a drop in permits for both multifamily and single-family homes as well. The capacity utilization, this is to the extent that factories are running at capacity. You can see that continues to trend lower. This is not a bullish signal for the economy, as you might imagine. Industrial production seems to be rolling back over as well. The U.S. Economic Surprise Index has taken quite the dip down below zero, means net negative. This is a read of how data have come out relative to economists' expectations previously about that data. So you can see that the Economic Surprise Index, it does not say we're in recession. It just says that the data is worse than what economists were expecting. All the while, inflation expectations, or really inflation compensation, is back on the rise a bit. These are CPI swaps. These are break-even rates, 2-year inflation break-evens, 5 and 10. So you can just see that they are hovering up here and actually accelerating here a bit of late. Commodities have popped. They continue to hold this upward trend line. Long-term, we're bullish commodities, although a recession, I do think commodity prices would come down, but of late, they've been on the rise. This is the Bloomberg Commodity Index. Price of copper has really been ramping up here of late, which is very interesting. So copper is really pushing the upper limits of these resistance areas here of late. And it's interesting because, the Fed met this last week, and listening to Powell and his commentary, he talks about the economy being strong, unemployment being low, and so on. Sounds an optimistic tone. All the while, the futures market is discounting about 100% chance of a rate cut in September and like a 75% in December last time we looked. And on one end, I would say that the data, again, home building sentiment, I mentioned what housing starts look like, capacity utilization, industrial production, the Economic Surprise Index, and again, several other indicators as well. On balance, I think is beginning to look weak. There's 43 indicators in our index. Only 7% are positive, 30% are negative, and 63% are neutral. So again, we're seeing deterioration in economic conditions. Now that jives with what the futures market is showing, and that is that there's going to be a couple of rate cuts this year. I think that makes sense based on what we're seeing here. All the while, you look at inflation swaps, right? You look at commodities, right, going up. And Powell did talk about inflation expectations are actually rising for this year and next. So what does that mean? That means we have an economy that's weakening with inflation that's rising. There's a term for that, and it's called stagflation. And that's not a good backdrop remotely for equities. Now, what's also on the horizon is the, quote, one big beautiful bill. Now, that could provide some serious oomph, if you will, to animal spirits. And we could see that reflected in the market. So I'm not in that camp that says that the second half of the year has to be a disaster for U.S. equities because of this recession risk. I do see the potential for, enough animal spirits provoked by, further tax cuts, an extension of the existing cuts, a resolution of the current Iranian-Israel situation, however that's going to look. Still a potential resolution in the Russia-Ukraine conflict. A ratcheting down and a settling at lower levels of the tariffs that the U.S. continues to threaten the rest of the world with, and so on. So there's a lot of uncertainty, there's a lot of negatives in this market from a sentiment standpoint that really all of them, I guess, the major ones could end up being resolved in the second half of the year, and that could provide quite the oomph for equities globally. And all the while, though, there's still the risk that these things aren't resolved, that the president doesn't, agree to settle at much lower tariff rates than what were originally threatened. July 9th is going to be key because that's when the delay of all those reciprocal tariffs expires. The biggest thing to me, though, from a long-term fundamental standpoint, is that U.S. stocks are exceedingly expensive on virtually all of the valuation metrics that we think count, versus, again, the rest of the world that's still trading at quite the discount, as I talked about, I think maybe illustrated for you even in the last video. So while I have a scenario that says it doesn't have to be all that ugly in the second half of the year, there is very limited upside on an extended basis for the U.S. equity market. Probably the best thing in the world for it would be to go back and test those lows that we saw last April. And that would be, 20% correction, come July, August or something like that. That would set the stage probably for a nice rebound out of this. If the market continues to hold up, I think that's going to embolden the administration to stay tough on the trade situation. It may take a serious market correction to get that part of the bullish thesis solidified, if you will. If the market holds up again, like I just said, I don't know. I don't know that the president would be willing to back off, given how strong he came at it earlier this year. So yeah, a lot yet to be determined. There's more I could ramble on about, but in the interest of time, let's just jump quickly to the charts. The S&P 500 is come out of this rising wedge pattern. This would be the sell signal, by the way, breaking below the uptrend line. But there hasn't been a ton of selling. It was, the stocks were lower on the week. You can see the blue candles here the last 3 days. Those are down days. And you can see this very solid resistance line right here, about 60.26 on the S&P. But make no mistake, at least on the daily chart, this is a bearish looking chart. That's a sell signal from a pretty high level on the moving average convergence divergence. Same thing for the NASDAQ 100 index. You can see that all-important 20-day moving average is holding as support right now. We'll see what goes on next week. The fact that we had this big run-up and have been holding this level, that death cross is about to turn into the so-called golden cross, and that's where the 50-day would rise back above the 200-day. This is a much better look going forward trend-wise than what we had back here, but the patterns, the sell signal in the MACD, the bearish divergence, which is still very much there, makes me very cautious right here in the near term. The dollar, as I mentioned, wouldn't surprise me to see a little strength, and we've been getting that. And it is just right now flirting with that downtrend line from the peak back here in February. So we'll see how that plays out. That's a short-term buy signal on the MACD, although it's losing a little steam. The RSI says it's not oversold, but it feels oversold to me right here. And it is interesting with all the geopolitical angst that we haven't seen, a remarkably higher dollar. And I think that speaks to what I started with, and that is that the world is viewing the dollar and treasuries differently, and U.S. assets in general differently going forward. And that's, that pretty much explains why we haven't seen, a ton of strength here in the dollar so far. The 10-year yield, you can see, is staying right in here, kind of a descending triangle pattern, which tends to be bearish. If you look at these points right here, these resistance, we do see a bearish divergence on the momentum indicators. We shall see. This basically suggests that the bond market would be discounting, weakness potentially in the economy going forward. But this is still a very high, in modern history terms or in recent history terms, a very high level on the 10-year. Despite the fact that, as again I started with this, the world not wanting U.S. assets or treasuries quite as much, the yield is hanging in there. Of course, typically, if treasuries were sold wholesale, the yield would be popping up. So this basically, I think the bond market is, very slowly or on a trend basis beginning to discount weakness later in the year, as opposed to, a big spike in inflation. It's going to be very interesting to see what happens if we actually get rate cuts and the passing of this spending bill at the same time. And because if we're not substantially weaker in the economy, you are going to see rates spike and you're going to see a mess I think, in both fixed income and in equities. And it's going to be ironic because the real fear should be recession and what that does to earnings. But if we got a spike in yields, that's not so good either. So not just the valuation argument that kind of has U.S. equities in a tough spot if we're looking for, substantial growth going forward. It's also potentially the yield and inflation backdrop as well. And then lastly, gold did break below this uptrend line right here. That would be a sell signal. Again, despite my long-term bullishness on gold, probably more bullish than I've been my entire 41-year career, I am not bullish in the short run. This is a weight on our portfolio, so we're hedging it fairly close to the money with put options right now, because I do think that odds favor gold going a bit lower. And it would be, probably positive geopolitical news. And by the way, as I speak on a Saturday morning, the news is not positive with regard to the Israel-Iran conflict. So we'll see how all that plays out. But gold is also not spiking to new all-time highs on that news either. So, folks, that one went a while. Hope it was useful for you. Lots and lots to talk about, but I promised I wouldn't keep you all day. So I'm going to leave it right there. Hope you all have a great weekend, and I'll talk to you again next week. Take care. Bye-bye.